Here we go. Welcome to Three Guys and an iPad, the proverbial Zoom hangout of the mortgage industry. I'm Brian Rieger, one of those three guys. And of course, we wouldn't live up to our name without our usual co-host. I'll start with Rick Grant. Mr. Grant, how are you today?
Doing well, Brian. It's good to see you again.
Always good to see you as well, Rick. And of course, from the beautiful confines of Austin, Texas, we've got Kevin Breeland. Mr. Breeland, how is the weather in Austin today?
Well, we had some thunder and lightning about 3 a.m. that drove the dog crazy, but by 7 it was all gone, and it's nice and sunny and beautiful outside.
Outstanding, outstanding. Well, it's great to have you here, Kevin. Of course, we've got a very special guest today, so we're going to roll right into that. Our guest has been in the mortgage banking industry for 38 years. He's been the Assistant Secretary of Housing and the FHA Commissioner at HUD during Barack Obama's first term. He was the longtime CEO of the Mortgage Bankers Association. He's also served as an SVP at Freddie Mac, an Executive Vice President at Wells Fargo, and the President and COO at Long & Foster. He's currently the CEO of Mountain Lake Consulting, and by now you've probably figured out that I'm talking about David Stevens. Dave, welcome.
Good to be with you guys.
We really appreciate you being here today. And I'm going to take half a second. This is the part where we make a shameless plug for the producer, Content Beacon, which, as we've said before, leading B2B content marketing agency in the industry. And I'll invite our guests, if you'd like to see yourself or someone else on the show, or if you have a show idea, just check the show notes. You can email me at brian@contentbeacon.com or rick@contentbeacon.com. But enough about us. Unless you've been living under a rock, you probably already know that there's been a lot of discussion in the last several weeks about the initial push towards easy forbearance, if you will. But we probably know that very little has been done to set up any kind of liquid facility or really any kind of backstop to protect servicers. Now, one of the most tireless advocates for a greater role on the part of the GSEs and the FHFA has been our guest, Mr. Stevens. You probably would also be living under a rock or in a cave if you didn't know that new FHFA Director Mark Calabria has been, shall we say, resistant to the idea of setting up a source of liquidity for the servicers. And there have been a couple of minor developments in recent weeks. Because, of course, on April 22nd, it was announced that the GSEs could buy certain loans in forbearance, and it limited the number of months servicers will be required to advance the payments of borrowers in forbearance. However, as we may discuss here, there are some strings attached. And very recently, there's been a little talk of there being an option of no lump sum at the end of forbearance. But again, that's just pretty recent. Dave, without further ado, I'm going to ask you the obvious question here and stand back. Is the FHFA doing enough? And if not, what should they be doing? What would you be doing?
Yeah, I appreciate having a chance to talk about this, and obviously it's been the top topic. I will tell you, just as an outset, I've been talking to CEOs of non-bank originators across the country, large and medium size, and all are absolutely frustrated and irate at its worst at the lack of response from FHFA. The GSEs were legislated and chartered, in a sense, to provide counter-cyclical support to the housing system, particularly during times like this. While they're there all the time, and that's create the TBA market and is critical for supporting 30-year fixed-rate mortgages and more, it's times like this when federal governments use the tools in their tool belt to stabilize the impact to an economy. And that's really happened across the board other than FHFA. Chairman Powell of the Federal Reserve stepped in with the open checkbook and drove the Fed funds rate down, bought an excessive amount of mortgage-backed securities, actually blew up a bunch of short positions on pipelines, but that all worked itself out. They figured it out and backed off. But they stepped in. HUD stepped in. Ginnie Mae set up a liquidity facility called PTAP. It had already been there for companies that were in distress. And they needed that for times when a Taylor, Bean and Whitaker might fail, and they had to make advances to the investors even if the mortgage banker didn't survive. But they changed the rules and said anybody can have access to this if you're an approved issuer in the Ginnie Mae program. And they already had a process for managing forbearance loans because they had done forbearance in the past. So the partial claim that you file and then ultimately the secretary's lien, which attaches to the back of the loan, was already in place. So people actually were pretty calmed by what HUD did. And then you have the White House, the President and Congress, in a sweeping bipartisan effort, passed the CARES Act and then passed a subsequent bill. But it was the CARES Act that created the forbearance piece, which we can always all talk about. But in the end of the day, who didn't step in and use the tools in the tool belt was Mark Calabria, the director of the FHFA. The impact, obviously, as we all know, of this forbearance program is it's massive because you don't even have to prove hardship, so anybody can opt in for it. 2, it's 6 months to a year, which is a lot longer than any previous forbearance program. And 3, there's no harm to credit. So there's no friction on the consumer side to say, you know what, I don't think I want to hurt my credit, even though whether I can afford it or not, I'd like to try to make it on my own. And so the take-up numbers are big. And by the way, Mark estimated there'd be about 1 million total forbearance loans. As of last week, we were well over 3 times that, and it's going to be more this week. So what they didn't do is establish a facility to provide liquidity for this unprecedented scenario resulting from the CARES Act, using these 2 companies which are still owned by the federal government. The majority of their stock is owned by the U.S. government, and they're in conservatorship, and have them put out a facility that would simply make advances to the investor on behalf of the servicer if needed. And that would have eased a lot of pain in the marketplace. Instead, not only did the director say he wouldn't do it, he added insult to injury by publicly in interviews saying, I'm fine letting non-banks fail. In fact, maybe the consumer's better off and we'll just transfer the servicing. That resulted in an immediate contraction of credit. And the JP Morgan story is the one that's most public, but a lot of folks did it. 700 FICO minimum, 80 LTV maximum, 43 DTI. If you're self-employed, you have to have 12 months of reserves in the bank. And that created a steamroller effect where everybody started putting in overlays of different sorts and different kinds, creating market confusion. And if I can just say, it didn't stop there. He then went on to talk about loans that decided borrowers who wanted to forbear after they had closed, but before the loan was sold. And he did an extraordinary move there as well, which we could talk about. But again, he is really, his libertarian views and I think lack of real business experience. He's an economist who went to work in Washington and never left, doing policy work, never actually ran an industry, now running the 2 biggest financial institutions in the world, perhaps. These 2 factors are extraordinarily harmful and may have a significant impact to the recovery of this economy as we come out of this crisis that we're in.
And to follow up on that, Dave, this is kind of who Director Calabria has always been, right? This is who he said he was. This is what he's doing. Is there anything we can do if the FHFA continues to sit on the sidelines? Is there anything else that could be done? Is there a way to do an end around there?
Yeah, I mean, there's a lot of things going on. The Mortgage Bankers Association, which for all of us, I think you have to recognize they're the biggest, well-funded, staffed voice in Washington. There are other trade groups that write letters and stuff, but none of them have the size and scope of the MBA. And the MBA has unilaterally been the most aggressive. However, because they need to maintain a relationship with the entities in Washington, they may not have been aggressive as some would like, but nevertheless, they've been all over this. And I congratulate Bob Brooksmith because when the FHFA made those comments about allowing non-banks to fail, he got very aggressive with the director, and that's the kind of voice we need right now. This is really a war that we're in, and this isn't a Republican or Democrat thing. As I said earlier, the rest of the administration came out guns a-blazing. HUD, under the leadership of Secretary Carson, Brian Montgomery, they did the right things. The president and the administration Republicans and Democrats in Congress got together and passed a bill that was needed to throw money everywhere in the economy. Somewhat lumpily, that's the way it happens during these times. As you know, I was in the administration during the last time, the Great Recession. But this isn't a Republican or Democrat thing. This is purely a collaborative thing. And to your point, yes, we've always known he's been a libertarian. I've known Mark for, I don't know, a couple decades maybe. I've testified with him in Congress on panels where he's given one perspective and I've typically given another. But I never thought he would be so malignant as he is right now in actually aiding and abetting the disruption of the credit markets, not just refusing to provide a liquidity facility, but even going further. And his love of the press is different than any FHFA director I've seen in the past, either Mel Watt or Ed DeMarco. Ed was acting, but nevertheless, neither of them were in the media as much as Mark likes to be. But his comments are harmful. And you can move markets when you're in that kind of role and you're saying you're willing to let a whole channel fail. And that means warehouse lenders start looking and going, man, if they're going to let a non-bank fail and I'm warehousing for a non-bank, I don't want to get stuck with a pipeline of loans that are unsaleable should the lender go down because of forbearance advances. So I'm going to put haircuts on that. I'm going to put penalties if your loans stay in the line too long, and I'm going to really start scrutinizing counterparties. And you've seen what's happened across the country. Bond financing has all but evaporated. Cash out refinances are now being pulled back everywhere because of the second part of his policies. Overlays are in place across the board at different levels. It's very confusing. It seems like this instability is not good for the markets. So some are at 640, some are at 680, some are at 700. People are moving more to best efforts, the mandatories. I mean, there's a lot of action going on that's truly harmful to consumers and consumer access to credit. And all of this is negative to recovery as we try to work out of this recession that we're in right now in the months ahead. And we know Mark's a libertarian. We know he believes government shouldn't be involved during crises. Markets should work their way out. He's supportive of the Lehman failure, not getting involved, and he thinks we probably shouldn't have gotten involved in putting Freddie and Fannie in conservatorship in the first place. But that's when he was a philosopher, an economist, a policy guy at the Cato Institute, or working in the Senate Banking Committee for Senator Shelby like he did. He was one voice. And by the way, that's a good voice to have in Washington. You want all perspectives covered. I think his voice as an academic or a policy guy with all the other voices that compete in the space lets everybody see the framework. I now see where that position stands. I see where the liberal position is, a consumer advocate at an extreme, and those across the full spectrum. I don't argue with that. But to put him in charge as the regulator, who's now basically the CEO de facto of two massive financial institutions, which should be there right now digging in and helping on this recovery, and for him to thumb his nose at it and then add again, as I said, throwing the salt in the wound methodology that he put in place, it's seemingly to me without thought, unless he's purposely trying to create a mass failure of mortgage banking and financial mortgage institutions across the country in the middle of a national pandemic. Is just absolutely inexcusable. And, Chris Whalen, who's a well-known person in our industry, an investor and analyst in New York, put out a piece calling for his termination. And so, this is a real extreme where it's affecting markets, it's affecting hedge funds that own CRT, the credit risk transfer programs, it's affecting originators, it's affecting warehouse lenders, servicing buyers, people who buy whole loans across the board. And, really entirely, solely his responsibility that we're here. And it's an easy problem to fix that he could fix so simply.
Great points, several great points there, Dave. And of course, we've mentioned Chris's writing a few times before on the podcast. I believe he even advanced, I don't remember, but I think it was Chris who advanced the theory that this might be intentional. I do believe I read something about that. But again, whatever the case may be, there's no doubt that the damage is being done from the bully pulpit at this point. And Well, we're going to move on a little bit here. Kevin, you had a question about non-bank servicers. Did you want to jump in?
Well, actually, I have a couple. So here's kind of the two-part question I have for you, Dave. You know, your top three non-bank servicers are Quicken, Freedom, and Mr. Cooper, who acquired, who was formerly Nation Star. And they account for almost 60% of all non-bank servicers. So when we talk about a liquidity problem, just how much money are we actually talking about that these servicers may be faced with having to come up out of their own pockets on a monthly basis, at least for the 4 months? And
right.
I've seen lots of different numbers, but I'm real curious in what you think that number is. So
we were at 5% in forbearance last week. We're over 6% this week, and we're going to keep going. I'm not going to name the economists because I'd want to share the research with you directly, but two major well-known economists, not with trade groups, are both expecting that we're going to be well north of 10% in forbearance. And Urban Institute has done an analysis. It says that roughly those numbers could equate to about $40 billion in advances using the 4-month cap. And $40 billion, to put that in perspective, the entire servicing industry last year made about $10 billion, maybe a little less, but just around $10 billion. So we're talking 4 times the total income of these companies. There isn't $40 billion there to have for liquidity. And so the challenge, Kevin, is this. Those 4 servicers you just mentioned, they likely can manage through this. They all believe they're going to be able to get through the advances. And Mark's actually talking to them as well, as is the Secretary of Treasury, who, by the way, is not Mark's boss, but Treasury's worried about this. So they're talking to the largest servicers. Servicers, the guys of that size can get syndicated advanced facilities with banks. And my own personal belief is they are too big to fail for the FHFA. So even if a lifeline were to be thrown, if they needed it, it might be thrown to a small circle of big dogs that are in the room. But there's a whole bunch of others. So there's 900 independent mortgage bankers, and as we all know, over the last decade, so many more got in mortgage servicing than ever in history. And there's what I would describe as medium to small IMBs. There's some in the cities where each of you are living that are retaining servicing, and they may be 5 billion originators, 8 billion, 10 billion originators that have been retaining servicing for a while. They don't have access to this kind of liquidity. And so what Mark does by saying, rather than doing a Powell move, which says, we're going to be there, we're going to cushion the economy, don't worry, we'll write the check under any circumstances. Or Congress, which says, we're going to throw money everywhere. Whether you need it or not, we're sending you money. And they did it a second time. Let's not talk about how easily it was for them to distribute the funds. That's a complicated thing in such a short time frame. I don't want to get into the operational aspects of achieving that. They did it. The intent was to cushion the blow. Mark has done just the opposite, and what that creates is uncertainty. And as we all know, working in this industry and understanding capital markets hate uncertainty. And so the fact that you say they're willing to fail, not knowing necessarily if there'll be a lifeline thrown, that's what creates a credit pullback. And it's really, in my view, the credit containment that's the most harmful right now. The fact that Wells Fargo stopped all cash out refinancing is only because of the first payment forbearance rule that Calabria just put in place over the past few days. We would have cash out refis otherwise. And so I'm glad that the big guys think they can get through it. It's a lot of liquidity. And by the way, they're betting on the numbers of how many will go in forbearance. I could show you, there's a great research piece that CoreLogic has done, Frank Notaf, where they show base case, worst case, best case. And the worst case is not what these servicers are expecting. If you get into 20% unemployment, which is a worst case scenario, instead of 10-ish or so, and then you see the subsequent forbearance reaction to that, that's going to blow a lot more liquidity needed. And remember, in this forbearance plan, unlike others, the loan is considered current by law. So it's not going to be pulled out of the pool. Whereas under previous forbearance programs, the ones we operated back when I was in, they were actually considered delinquent on the first forbearance payment. You got 30 days late. Nevertheless, you still got money. And by 120, the loan is pulled out of the pool. And then you go into the waterfall as established under HAMP, et cetera, to provide that consumer options, that homeowner options, to try to get them back reperforming or help them as gently as possible, ease their way out of ownership. This is different. This stays in the pool. So when does the servicer ever get paid back for those advances? So, 4 months of liquidity that sits out there for maybe a year, year and a half, 2 years on a payment plan, it's a long time to get replenishment. And as we all know, this is a mismatch on timing, right? The GSEs own the servicing. Freddie and Fannie, by contract, own the servicing. They advance servicing rights, that's what we call them, MSRs, to the servicer to service on their behalf. They own it. If the loan reperforms, everything gets replenished. So if the GSEs set up a credit facility, liquidity facility, they either get replenished. If the loan goes into default, ultimately, they've guaranteed the loan. They own the loss anyway. I mean, this is a ludicrous proposition where the GSE should be used. So to bring this back home to your question, the liquidity is big. Whether everybody's going to need it or not, I think varies based on their size and sophistication and access to support. I'm confident some will need it, and that's why the CFPB put out a bulletin a few days ago on how to transfer servicing seamlessly in the Corona crisis. But not all are going to need it. But it's also the Calabria communication of uncertainty that's whacking the hell out of the credit market, eliminating access to mortgages for a whole bunch of people. And that's been sized as well.
Well, and to take that part a little bit further, let's talk about the contraction of credit, because, we've both been in the business a long time. And, there are situations, I don't necessarily believe in this process, but you can originate yourself out of a problem if you're in a good market, in a good, strong market with good rates, and whether you're correspondent or direct, if things are working well, you can kind of work your way out of it. That's always been one of the great things about our business. We can almost make ourselves recession-proof if we don't have the politicians involved. But in this particular case, there's a retraction of credit going on that was completely unforeseen by everybody. No one was talking about this till just a few days ago.
Yeah.
And yet, as a daily originator, almost every day I kept seeing changes on what we had to do to qualify people and the continuing tightening of the markets. Self-employed people, you have to take a 25% haircut right off the top. Right. Regardless of what their tax returns say, just take 25% off of that. If a person has bonuses and commissions, you got to take a 25% haircut off of that. I mean, these types of retractions. And fortunately, it wasn't really affecting any of my customers, but now I've seen situations personally where really good quality FHA customers, for example, are now getting hit because the lenders themselves are starting to raise those overlays higher and higher and higher, where they're so unwilling to take on that risk. So let's say 60 days from now, the coronavirus process is better, and we have a much better handle on it across the nation. We're getting back to business as usual. If FHFA makes no more moves, if they've done nothing, what do you believe Congress might do, and how do we get this contraction of credit stopped?
I'm going to apologize to all you. I have a dog in the background that may bark and has been, but that's Chloe. She's been part of conference calls for years.
Mine's been drinking water while I was talking.
Dave, I'm glad it's yours, Dave, because I don't have a dog and I was starting to wonder. So okay.
There's this is a big deal. And a lot of us have been talking about it for a while. Consumer advocates in particular, they did a joint letter calling for a liquidity facility because they knew this would happen. The Urban Institute, which is a really well-known research think tank in Washington, headed by Lori Goodman, who's really well-known, particularly in the mortgage-backed security marketplace, and is relied upon for testimony and data. They put out a quarterly chart book this last week, and they took the overlays just of J.P. Morgan. Now, I granted J.P. Morgan's is a little more severe than others. You don't have all of those over there, over all your loans. You can find nooks and crannies where you can get loans done. But if you did the 700 FICO, 80 LTV, et cetera, she went back and applied all of those overlays on top of Fannie and Freddie's last year production, and 70% of loans would have failed at least one of those overlays. Mm-hmm. So it's not that bad. But I then went to a couple of large independent mortgage bankers, big ones, and I asked if they would take their current overlays that they have and do the same exercise, apply it over their last year's book of business and tell me what it cut out. And the number's around 20%. So we've seen about a 20% contraction. Now you gotta, I don't think we're done yet. I think I was on a call with another independent mortgage banking group this morning, and I told them it's going to get worse before it gets better. You know, we're just seeing this begin. A large non-bank lender last night told me, originator and servicer said cash outs are basically going to be gone here shortly, if they're not already. Asked Mr. Cooper, as we all know, closed down their entire wholesale division, and I don't think we've seen the end of that yet. But the core point here is when you put a FICO score of 680 or 700 minimum, you're whacking one core constituency, which is first-time home buyers, which are heavily concentrated with minorities. And so, yeah, there'll be a lot. I could get a loan under these guidelines, no sweat, as could all of you guys. But you know, I will tell you the demographics of what credit is going to look like during this period is going to offend particularly those that worry about access to credit for minorities and young buyers. And the reason why first-time home buyers tend to have lower credit scores, they're not all that way. It's not just because of student debt. It may be because they just didn't have credit. And they recently got credit after college or tail end of college. They haven't had the chance to build up a good FICO score, which is the scoring model we're stuck with. And so, you know, to that end, you're really killing the hottest part of the market. There's some great data that I got from CoreLogic, from Frank Notoff this morning, which looks at where all the market demand is coming from. And it's young millennial first-time buyers. They're driving the entire purchase market right now. That's why if you see homes in Greenwich, Connecticut, the McMansions, they're sitting on the market. For sale signs have been out there a long time. There's not a demographic to move into those big homes yet. There will be, but the big buyer population is in their early 30s for the most part. The biggest cohort of the millennial generation. And they're all wanting to buy. They don't have the strongest credit scores. And so we're killing them. And again, to your point, Kevin, the self-employed borrower just got screwed. And in today's world, we have a much higher percentage of those who are contract employees or self-employed or multiple jobs that just won't get access. So yeah, this is severe in terms of that regard. People right now as we speak, the lenders aren't feeling it as bad because every originator has a huge pipeline right now they're trying to fund. And every originator, if they're not funding more this month than same month last year, or maybe double this month versus same month last year, they missed out on something because every lender is. It's a big funding month, even with what's happening. But yeah, you cut out bond programs, DPA programs, you put overlays in place. You know, you're targeting the one part of the market that typically that needs access to credit. And I'll just finish your answer to this question, that we all need to remind ourselves, and economists will always say, credit is the lifeblood of an economic recovery after a recession. Access to credit is the lifeblood. You need to be able to issue debt in order to get an economy recover. People need to be able to charge things, buy things, borrow things, get cash in their pockets, buy homes to get to buy the new refrigerator and get a cash out refi to get an extension on their home done, or whatever it may be. this is all about spending money. And if we can spend enough money coming out of this, we're going to hire a boatload of people faster than we otherwise might, and this economy kicks back into full gear quickly. If you constrain credit, you screw the recovery, and that's literally the position we're in today.
Well, Dave, let me ask you this, back to the hypothetical a little bit, but is there a point, are we on the clock? In other words, is there a point in this where the damage can't be undone if the FHFA stays on the sidelines?
Well, for every week that the FHFA doesn't step in and do their job, which is really what's happening here. Mark Calabria is not doing his job as a regulator. He's may be doing his own ideological belief, but that's not the job he was hired for. So as long as he refuses to do his job, we're going to have this sort of extension risk and overlay risk in place. And it's, again, as I said earlier, it's only going to get worse. More are going to follow, right? We heard Wells first stopped cash outs. Then Penny put the policy out on the delivery fee. Should there be a first payment forbearance? Then Flagstar came out yesterday afternoon. Franklin American, by the way, in the middle of this came out, et cetera, et cetera, et cetera. I don't mean to be naming them, but that's what we've seen. Mr. Cooper shut down wholesale. We're just seeing this. This is the dominoes that are happening. We've seen them in previous market scenarios like this. And this is, in my view, just a beginning because nobody wants to be the point of adverse selection. Or very few do. There'll be a few cowboys who view this as an opportunity to stay in the game. But it's going to shrink pretty precipitously. And so the question on the clock, I think the servicing industry probably has enough liquidity, and based because we only have right now about 6% in forbearance. I'll be curious to see the numbers at the end of the week or early next week. But as the numbers grow, it's going to get a lot more expensive. In the short run here, servicers can likely make advances. And originators still have enough access to enough product and are funding their pipelines that they're feeling cash rich right now. But that's going to run its course. And the percentage of the number of refis is going to drop, and obviously purchases drop dramatically. Even though we know there's purchase business going on, it's still going to precipitous fall off based on the data that I'm looking at. So, how long can we last here? I think we need to push really hard and get this done as quickly as possible sometime in the month of May, or we'll reach a point where, we've tried every possible angle and we're stuck with this outcome, in which case I would start leaning not towards the base case estimates on recovery paths. I would start edging up towards more of a worst case. And that'll be inexcusable as we think about this going forward.
Well, and
by the way, everything I'm sharing you comes from data from folks like Mark Zandi at Moody's, Frank Notaf at CoreLogic. I talked to a group in Chicago yesterday with one of the largest accounting firms. This is not guesswork material. Everybody has kind of the same projections. Mike Fratantoni at MBA. They all have the sort of base case, worst case, best case scenarios, and they're all very similar. And they all have the same concerns about the lack of responsibility that Calabria is taking on to do the right thing, like every other federal agency is doing.
Well, and you mentioned a lot of big names there, Dave, and UI as well. These are the heavy hitters. Yeah. This isn't just conspiracy theory stuff. I know right. Kevin has another question for you. I want to go, but you touched on something here. I want to go back. You mentioned the best case, and you mentioned the worst case scenario as played out by CoreLogic, and you mentioned it again there. What does that worst case scenario look like? And then what does the best case look like?
I'd have to pull it up. And I don't want to do that during this.
Oh, just on the high level. We don't need the hard numbers like that.
I think it looks like 20-ish% unemployment rates, and then high teens to low 20% take up rates on forbearance, and then cum impact on forbearance advances, getting closer to more like $70 billion, something along that line. I'd have to, but I'm paraphrasing because I don't have I literally just read it. It was sent to me this morning by Frank, and I'm putting it together for some thing I got next week. But anyway, it's bad, right? It's and even if it's short term, the harm is just so deadly. And And the fact of the matter is, the quicker we can get our way out of this, back to work and kickstart. Two economists I spoke with last night at length told me, I think I said this earlier, that their research that they were drafting for their a report they were planning to put out next week was an expectation that housing would lead the economy out of the recovery. And now after the conversation with me, they're like, wow, maybe we need to relook at that forecast. And so anyway, all of this to say is we just need to put pressure. And by the way, there are valves that can be played. So there's a third bailout bill, as I hate to call it a bailout bill. There's a third recovery bill that's being worked on right now. And there's alleged text that the NBA has been aggressively working on the Hill that's drafted and hoping to get placed in the bill that would create an advanced facility. So if another piece of legislation is passed over the next couple of months, and there's, it's getting more divisive as we go through this, but let's assume there'll be a bill. If they can get that ledge text language in there, then problem relatively solved. But there are other things that can be done to put pressure on Calabria. I'll just give you one example. Dick Bove, I don't know if you know the name. He's one of the hugest pro GSE recap and release shareholder representatives and a big shareholder. He put out a newsletter just in the last 24 hours where he is assuming that Calabria's job might be at risk because this is eking into the White House and people will begin worrying about votes. And the president's patience with folks that he doesn't think are on the same page. And he's terminated many other Republicans. He sure as hell doesn't need one that's causing him problems. But it was interesting to see it in Dick Bove's newsletter, because then his conclusion newsletter to shareholders was, this is another net negative to having an optimistic timeline on recap and release. So we're different views of how to do what the GSE should do going forward. But I found it interesting that even he, who's on the other, we've been often on the other sides of the issue, opposite sides of this issue, is now viewing a possibility that Mark can get terminated. Honestly, Mark either needs to change his perspective or something like that, I believe, needs to happen. He is. I've been quoted on this before. He's the worst person to be in this job under had we not had the pandemic, by the way, nobody was that worried about. We didn't know what recap and release would look like. And I actually believe he would constrain the role of Fannie and Freddie. That's negative for industry, but that was yet to be seen. It's the pandemic that brought out his true colors. And now we're seeing how his inability to do what's right during this crisis, when there's legislation to help small businesses being passed everywhere you can look at, and here he's willing to let a whole sector of the industry fail, is just crazy to me. I mean, this is so fixable.
Well, and I think Kevin had a question for you along that line, Dave. Kevin, you want to jump in and ask that?
Well, I think we've kind of talked a lot about Mark's position and is this an intentional move on his part to move non-bank servicers out of the game and just moving into the big banks? But I also would like to kind of sideline that question and ask this. Now, I do remember reading and listening to a podcast where Senator Warner was some other bipartisan, as I recall reading the article. He had support on both Democrat and Republican side, was working on some legislation to kind of do Mark's job for him. So, and when I was reading that, you were quoted in that particular article as well. So what's your view of that? Is that something that they could actually do that could
Kevin, so that's
circumvent what Mark's doing?
That's the legislation I'm talking about, which is this third bill. And Senator Warner and Chairman Crapo of the Senate Banking Committee, who's a Republican from Idaho and a really good guy, they get this. In fact, everybody in the Senate Banking Committee, for the most part, gets this problem. They wrote a bipartisan letter mostly from that committee, even split Republican and Democrat, to Mark, calling on him to set this up. But legislatively, that's where this ledge text approach is being taken, is through the Senate to try to get it into the next piece of legislation. I'll tell you also, the House of Representatives, it wasn't just the Financial Services Committee, they did the same thing. They drafted a bipartisan letter, sent it to Mark, and actually a group of Republican members of the House, only Republican, had a call with Mark where I hear that voices rose during that conversation from some of the House members calling on this as well. I mean, they get it. You got great Republicans in the House like Patrick McHenry and French Hill and others. Yeah. They understand our business, and they get what's going on here, and they're not supportive. If we can keep rumbling up, I mean, if we can keep the industry incessantly calling their member of Congress every week, I mean, you have no idea. I mean, Kevin, you spent time doing this stuff in D.C. a little bit, and I assume all you guys have. They listen to who calls them, and I think people underestimate the power of their voice. If all the state MBAs and mortgage broker groups, and I'm doing Kevin, you probably know I'm doing a joint Texas MBA broker call. We need people in every state to constantly call their members and say, you're risking my employees' careers. And Mark Calabria is. Compliment them on the legislation they've done to try to protect the economy and what a difficult time is. We appreciate everything you're doing, but this guy is single-handedly risking the housing sector. I think we all know the president will respond to media as well as calls from his own party. And that's where the noose has to tighten, because ultimately, if we can get, pointed questions being placed to the president or to Jared or, someone in the family, his chief of staff who, comes from the Hill and understands somewhat of this stuff, that's where we need to focus on. And it's really important. I mean, you guys are going to start feeling it. We're all going to start feeling it. Everybody in the business, I don't care. I don't do loans anymore, but everybody I talk to, I care about. And, you got to think past the current pipeline and look forward to where the next loan's coming from as we continue whacking away at available product. And as you know, jumbo's really limited. Non-QM is gone. So this is a pretty bad scenario.
Well, it is. I mean, it's all of those things. Everything's great today as far as closings, but what's it going to look like in August, September, October, November, December?
Let me give you one parallel, which is good for the industry to think about. Back in the last Great Recession, one of the things that everybody benefited from was the Fed stepping in and creating a short in rates, which drove rates really low. They bought a ton of MBS through quantitative easing. And then HARP 2.0 was passed, which allowed refinancing underwater loans, Fannie to Fannie or Freddie to Freddie, almost no questions asked. That's how you use tools government during a recession. And that's how you use Fannie and Freddie during a recession. They're 60% of all mortgages have been going through them. They're critical tools that should be put to use right now.
Well, some powerful stuff there, Dave, and I really do appreciate you being on today. I've got one more question for you, and this takes a little more of a personal note. I understand that you and your wife have been very involved in the fight against prostate cancer. Would you like to talk a little more about that?
Yeah, so I think I've been pretty public with the industry. I got hit with an advanced stage of prostate cancer, and for anybody who's had a family member or friend who's had advanced stages of any kind of cancer, breast cancer, prostate cancer, you name it, once the horse is out of the barn, it's called metastatic cancer. And so it's incurable once it passes out of wherever it is, the breast, etc. It may take years. Sometimes it's quicker, sometimes it's slower. But so far, they haven't found a way to attack cancer cells that have spread in the body. And my cancer is one of those. Fortunately, I have a team at Johns Hopkins, which is one of the most outstanding teams fighting this disease. And we've been raising a lot of money for them. The industry's given generously. We've raised, well over $1 million over the last 3 years for the Brady Urological Institute, headed by Ken Pienta. And just to give you an idea how renowned this guy is, I can't name names because they're in our industry, but there are several others in key roles that you guys wouldn't even know you would know who they are. But nevertheless, they have it as well. One is going to USF, which is considered one of the best cancer research hospitals in the world. And he tried to get me to go to talk to his doctor. And I said, ask your doctor about Ken Pienta. And he goes to his oncologist, and his oncologist says, oh, I studied under Ken Pienta. So since then, I've now talked to people around the country who Johns Hopkins asked me to speak to, or friends hear about friends, or have a cousin or something. And people are flying in from all around the country to go to the Brady Urological Institute. They're ranked number 1 or 2 in prostate cancer research and whatever treatment. Next to the Cleveland Clinic, by the way, Mr. Ohio, and it's an extraordinary team. I've had treatment in Germany that's not available in the United States that it takes too long to explain here, but there are new treatments coming out, and the progress in treating cancer is revolutionary over these past couple of years. So, that it just takes money, and we give generously to a lot of causes, and obviously this is one that's close to our heart. And if anybody else wants to learn more, you can always reach out to me, and I'd love to, send you the links so how you can give a few shekels to the team at Brady to help continue their research.
Very admirable, Dave. Where could they email you for that, or how can folks contact you?
Twitter, LinkedIn. A lot of people message me through both of those. LinkedIn is what I use for business. A lot of people trying to friend me on Facebook from the industry, but Facebook I can sometimes get a little political. Yes, Kevin, you may understand that, but my email is dave@davidhstevens.com. dave@davidhstevens.com. And you can feel free to email me or reach me through my LinkedIn page. I also have my business email, David Mountain Lake Consulting. They both go to the same place, but either one works.
Right. And
I would add this one piece. So Dave, even though, I know this cause is very dear to your heart, and you and Mary have done a lot of work to raise money. I know our listeners are going to want to step in and help as well, and to try to raise awareness. But one of the things that you talk about all the time, if you just mind taking a moment and talking about it, is people getting testing. With my heart condition, and I would do talks with the American Heart Association, telling people that, something doesn't feel right. You're not Superman. You're not Superwoman. Yeah. Go to the doctor.
Yeah, and men, men in particular should go. I mean, I was religious about physicals. I got a physical every single year with a PSA test. I'll tell you, I'm not going to name the hospital. Everybody says you should sue them. I did a full 360 executive physical at a well-known hospital in the D.C. area, and PSA was one of them. They forgot to do it. And so I got all my results back, and the cardiologist said, whatever you're doing, just keep it up. You do the treadmill test, the whole 9 yards. You're there for a whole day. And they forgot the PSA, so they called me up afterwards, and they said, we forgot to do your PSA. We're really sorry. You can come back in. I was like, oh, shit. Well, all my results are so damn good, I'm just going to wait till next year. Bad mistake. And so you need to go in and get a physical with a PSA. And last thing you want to do is be surprised because the disease, the cancer I've got is so curable if you can catch it before it gets out. And so, I'm now at a point where I tell, gallows humor jokes and joke to my kids about, I'm going to be dead and haunt you. And it just freaks people out, which I like. I like getting the reaction, but, no matter how long this has been, we all live a short period of time on this earth, 100 years, 90 years, 70 years, whatever it is. And I have a stronger view about what happens next. And, right now it's about doing what I like to do in this business, spending time with my family, with my grandkid and the next one coming, and living life is charging as hard as I can. There's too much fun to have.
Well, and I can relate to that because with my heart attack and being dead for 45 minutes and coming back, and I remember the first time you and I saw each other after all that happened. You said, I just found out. I would have called you or emailed you, and I just found out, and it meant a lot to me. I mean, when people reach out to you, there is nothing more that can help build your spirits than realizing how many people care about you. Yeah. But one of the things that I say in my talks is, when I get started, is that I might be the only person that God and Satan rejected on the same day.
Oh, man.
That's a good one, Kevin.
Even your dog liked it.
Yeah.
Well, Dave, we really appreciate you coming on today. Stay well. We know you're doing. You're fighting the good fight right now, and keep that up. I'd encourage all of our viewers, all of our listeners, to take a moment, consider donating to the cause as well, and just reach out today. But I think that's all the time we've got today. As always, Rick and Kevin, a pleasure. Thanks for being here again. And, of course, to our special guest, David Stevens, we really do appreciate you coming on. Hopefully you'll join us again at some point.
Sure, would love to. Good seeing you guys.
Oh, fantastic. Well, on that note, you may not know this, Dave, but we record on an old second-generation iPad. We're down to about 2%. So, Mr. Grant, please take us home.
What an honor having David Stevens on the show with us. A fantastic leader that we are blessed to have in our industry. Now, I didn't say a lot during that interview because I'd already had a chance with Dave about a year and a half ago. When National Mortgage Professional made him their Mortgage Professional of the Year, I got to write that story. And I got to visit with him at length and a number of other folks in the industry that he knew. And I learned a lot. I'll put a link to that article in the show notes. One of the things I think all of us can learn from a guy like Dave, first of all, is about the health stuff. So please take that seriously, especially if you're a man over the age of 50. We need to really bear in mind what he says, and if we can, support the work he's doing, the hard work with his charity and his family. But beyond that, guys like David Stevens, they're very rare, and we need them desperately. But we also need to learn to follow their example. What he's doing, the hard work he's doing to make the industry better for all of us, is the same kind of thing we can all do if we're willing to. Hopefully that's a lesson you took home from this episode, and I hope you will see you next time.